Hello, and welcome to this episode of To The Point. I'm Neil Stanley, and today we're going to talk about how to evaluate new deposit initiatives. The industry's changed a lot, but the basics of deposits are still in play. We have DDAs, the traditional demand deposit accounts or checking accounts. Then we have the non-transactional, non-maturing interest-bearing accounts. And then we have the traditional CD or term deposits. So when we think about these categories, we know this is what's on our call report. We understand these categories. But our financial institutions today are coming up with innovations, new initiatives to try to tweak or change things in such a way to create value. Let's think about that today. As we think about any initiative we do in our business life, we need to think about the decision tree. Is it desirable? Will everybody involved see it as a beneficial opportunity? Is it feasible? Can we technologically achieve this? Is it stable? Do the results that are produced, are those consistent results? Is it profitable? Another way to say this, are the resources that are invested less expensive than the output that is produced? Is it scalable? When we think about this, if we do it, is it limited in scope, or can we scale it and really make good use of this on a larger operation? Is it optimal? Of all the things we could do, is this the one that doesn't foreclose out other things that might end up being better, bigger ideas? So when we think about deposit accounts, we can kind of narrow down some of these decision tree questions. Let's ask the simple question. Is it fair? Is it fair to all the depositors, the ones that we've had, the ones that we plan to get in the future? Will they see it? Will it be observed as being fair? Is it intuitive to the people on our team? Will they look at it and say, wow, I wish we would have had this before. This is really good. It's desirable. It's dependable. It's scalable. We like it. When it comes to the value, there are three things that we should always look at. Are the accounts safe? Are they creating value? And are they liquid or accessible? Because remember, it's always the depositor's funds that we're talking about. So when we're talking about their funds, are we giving them access that's appropriate given the arrangement that we structured? Because only the financial institution can actually structure the accounts. The depositor is addressing or responding to what we have structured as a financial institution. And lastly, does it work? Are we getting more than our fair share of properly priced deposits? Because we are all about attracting and retaining properly priced deposits. So when we think about these evaluation tools, we can think about it in the context of some of the things we've been seeing in the industry recently. We've been seeing tiered pricing, ad hoc exception pricing, odd term CD specials, out of channel or brokered deposits, new money only offers, and relationship pricing. These are all tactics that are being used. They have advantages, disadvantages, challenges. And what we want to do is find that set, that combination that makes sense and really creates the impact that we're looking for. So today what we're going to do is a little case study. We're going to take an idea that I observed on LinkedIn. And when I saw it, I thought several things. I noted that it emphasized yields. It identifies itself as a CD, but it says it's flexible. So CDs are not seen as flexible. That's the downside. So if they've created a flex feature, that could be valuable. We also see that there are intervals in which there are withdrawal opportunities. There's a minimum balance to open that's $10,000. This is not a digital offer. You have to visit a branch or a local office to arrange this. Balances over a certain limit will earn a lower APY. That's an interesting thing. Usually tiered pricing, we pay more on larger balances. There's a 30-day interval between no penalty withdrawals. It's a 12-month term, and all deposits are using the new money only approach. So this brings up lots of issues, lots of questions that we can look at with this particular case study. So I sent these questions. Is the rate on all balances in the account variable or just the balances over $250,000? Does the bank plan to continuously pay less on the large balances? How is the early withdrawal penalty calculated? On what withdrawals does that apply? Does the withdrawal provision apply only to the amounts added after opening the account? And does the withdrawal provision require withdrawal exactly on the 30-day interval? Or do we just wait until 30 days have passed at least between withdrawals? How does the bank handle depositors who move their money out temporarily and then bring it back in? Is the account automatically renewable? Do the flex features carry over into the next term after automatic renewal? And ultimately, could we just put $10,000 in the account, establish the term deposit component, and then subsequently fund the account with additional funds that we can treat as a savings account and withdraw every 30 days? So the responses I got back from the issuer were interested. They said the interest rate is variable on balances above $250,000. It's hard to predict what's going to happen, but currently those rates are 4.39 as stated in the ad. Customers are allowed to withdraw any additional funds beyond the opening deposit amount without penalty, beginning 30 days after opening the CD and once every 30 days thereafter. There are no minimum time requirements in order to fund be considered new money to qualify. And the account is currently not automatically renewable at the end of the 12-month period. So this is a one and done deal. That'll be an interesting thing because we always counsel our clients to make all CDs automatically renewable. And yes, as I proposed, we could open the account. The term deposit account function would be on $10,000. That's a fixed rate over the period of time. But the account holder could manage the balances by adding to and withdrawing over time. So when we think about this and other types of new initiatives, we want to review those basics. Will everybody see this as fair? Will the team see this as something they want to be involved with? Will they see themselves providing trusted commitments to that depositor of helping them take care of their money? That's a key thing in this environment today. And when we think about the distribution of value, the yield and the liquidity trade-offs, does this hit the mark? And ultimately, the market will decide to give you deposits or not. And if you get those deposits, do you like, as a financial institution, the net result? Are you getting the right optionality for the bank at the right price point and the right volume? So I hope this has been an interesting case study for you. It's been a pleasure to present this episode, and I know this is going to bring up questions. So I would love to visit with you. Use my Calendly.com appointment app right here. Set up a time to go over this topic or other things that you want to review with me. It would be my pleasure to meet with you on a private setting. It is my pleasure also to present these episodes of To The Point. I look forward to the next one, and until then, make it a great day.